What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at some very suspicious behavior recently by the Federal Reserve. Most of you are probably already aware at this point, but just in case you're not, last week the Federal Reserve announced that they were going to be discontinuing their traditional measure of the money supply, and that is the M2. That is that there's multiple ways that the total money supply is calculated. There's M0, M1, M2, M3, and others out there as well. But M2 is one of the most commonly used sources to measure the total supply of money out there. They decided recently that they were going to discontinue this and replace it with a new way to measure the money supply, and they're calling it M2 still. It's just measured differently. So today we're going to look at number one, what are the differences? What are they leaving out in this new measure? Number two, what are the possible reasons behind why they might be doing this? And number three, what are some of the ramifications that are going to come down the road as a result of what the Federal Reserve might be trying to cover up? Ready? Let's dive in. Take a look at this chart. This is the traditional measure M2, the money supply, the money stock. You can see here, obviously, pretty much any measure of the money supply, you're going to have a spike at the beginning of 2020 when a bunch of new money was pumped into the system to deal with COVID. Now, you can see here that it says discontinued on it. Now, what we're going to do is we're going to look at two more charts here, and these are the replacements for the old way the M2 is measured. This first one here that we're looking at is non-seasonally adjusted, and this one right here is seasonally adjusted. Now, the only difference between these two is that one of them is smoothed out. You can see here one of the non-seasonally adjusted line is a lot more volatile. The seasonally adjusted line is a lot smoother. Personally, I prefer to never look at seasonally adjusted data because while it does smooth out the chart and eliminate some of the noise, by the time signal appears, it is usually too late. And so you do get more noise in charts that are not seasonally adjusted. But if there's something significant happening, any new change, any signal versus noise, you tend to see it earlier because the data, the raw numbers show it sooner than you would see if you're looking at data that's been adjusted per historical seasonality. So we're looking at mainly this new one is non-seasonally adjusted here. And as you can tell right now, it doesn't look like that much of a difference. And that is because they have not completely switched over to looking and reporting this data with the new data set. So that's number one. What have they replaced it with? So what are the differences then? Let's look. In the description, it says this weekly series is discontinued and will no longer be updated. And it gives you the links for the new ones there. Okay, so fairly transparent here. And let me pause here. I don't want this to come across as me saying, hey, they're trying to cover up some banking crisis that is definitely going to happen, or that's, there's definitely 100% nefarious intentions going on behind the scenes to deceive, people and institutions and people, actors in the economy. It could very well be just not innocent, but by all good intentions, their, best efforts to portray the information that they feel is most relevant to M2. That is possible. But when I started looking into this and realizing, hey, you've changed the way that you're reporting data, number one, it just looked suspicious right off the bat. And I thought about it for a long time, actually, trying to figure out why would they change the information, all the data that's coming into this. Specifically, what we're going to look at, the one main thing that they're eliminating from reporting for M2. And then a report that we're going to look at in a few minutes came out by Alistair McLeod on goldmoney.com, where he's talking about some things that are going to be the results or potential results of the draining of the Treasury General Account. So we're going to put some puzzle pieces together. That's where we come into some contact with some things that make this look like it might not be the best intentioned way to report money supply. So let's look at this. What are the differences? What did they eliminate? Okay, so here in this section, you can see where where it says before and after what the differences are going to be. So before May of 2020, M2 consisted of number one, savings deposits, including money market accounts. Do we see that in the change? Savings deposits including money market accounts? No, nowhere to be found. Okay, number two, what is in the prior data? Number two is small denominations time deposits. Do we see that in the new one? Small denomination time deposits. Yes, we do. All right, what else? What else is it reporting? Number three, balances in retail money market funds, less IRA QO balances. Do we see that balances in retail money market funds? Yes, we do. And is there anything else? Okay, no, that is the extent of the changes. Maybe not behind the scenes, maybe not with some of the nuances, but the main difference is that the new way that M2 is being reported is to exclude savings deposits, including money market deposit accounts. So again, like I said a few minutes ago, it is just kind of suspicious. Why all of a sudden would the Federal Reserve eliminate savings deposits, including money market deposit accounts, from the way that they've traditionally measured the money supply, M2. Now, like I said, this could be nothing and it could be no big deal at all. But especially in light of the recent rapid expansion in broad money supply paired with the fiscal policy going forward for this year, the amount of money expected to be spent into the economy, and the fact that that money the government is spending is not coming out of the economy from somewhere. Governments can spend money from three sources. The first source, they can tax the economy, redeploy that money somewhere else. Number two, they can borrow from the economy. People, individuals, institutions, retirement accounts can buy treasuries, which means they're lending money to the government. So that's money coming out of the economy from somewhere through lending, through borrowing, and the government re-spends that into other places. That's not where this money is going to be coming from. The extent of the money coming into the United States government's account, the Treasury General Account, from borrowing out of the economy and from taxing is far less than the amount that they're spending. The balance of this is called debt monetization. It is money printing. The Federal Reserve goes into the market and buys treasuries. They're lending money. They're swapping reserves into bank accounts, and they're giving banks reserves in exchange for treasuries so that the market, these banks, the primary dealers, can go in and send that money through to the government. So it's indirect, but the Federal Reserve is printing money in order to get that money into the hands of the federal government for them to spend. Now we have to pause here for a moment because this is where things start to get interesting. So far this year, the plan by the Treasury is, number one, spend a lot more. Number two, don't borrow anymore. Add on top of that the fact that the Federal Reserve has made no indications that it is going to increase the amount of money it's printing to buy treasuries, which is, again, money that's printed to go to the government's spending account. It's not going to be increasing that. So think about this for a second. If you're a person, a company, an entity, a government, and you're saying, I'm going to spend more than I'm bringing in income, I'm going to be increasing that amount, but I'm not going to borrow any additional money in order to do so. How is that going to happen? The only way that that can happen is to draw on your savings, right? You must have a slush fund somewhere. Well, it turns out the federal government actually does have an account, a savings account, if you will. It's held directly at the Federal Reserve. It's called the Treasury General Account. It currently has about $1.6 trillion in this. Now, historically, that amount was a lot less. Back before the financial crisis, that amount was relative to today, it was nothing. At the financial crisis, the amount that was going in, that was held on average in the Treasury General Account shot up to like $400 billion on average. The reason for that is because prior to the financial crisis, the Treasury General Account was held inside the banking system. So it was included in bank reserves. That money was inside the banking system. Well, during the financial crisis, when they had to increase the amount of base money in order to bail out the banks and deal with that financial crisis, they didn't want the system to be flooded with reserves. It would have crushed the banks. And so what they said was, all right, Treasury, federal government, we're taking your bank account out of the banking system. It's no longer going to be held in the banking system. We're putting your account directly with us at the Federal Reserve. That means any money that comes into the government through the government borrowing or from taxes coming in is held outside of the banking system. So it's like an overflow system for bank reserves. That way, anytime the banking system gets too full of reserves, basically to where most of the banks are at risk, that those reserves overflow and fill up the Treasury General Account. So you'll see it fluctuates, and then all of a sudden it spiked and just went off the charts. What happened here? Well, obviously this was 2020, and so when COVID happened, $3 trillion was spent, handed over to the federal government, and because they borrowed, let's say, $3 trillion just about, and in order for their spending, because they wanted to spend a lot of money in order to deal with COVID. But they weren't able to spend it all. In fact, 1.6, 1.7, 1.8 trillion here at the peak was stuck in this account. They didn't spend all the money that they borrowed. So now their plan is they're going to spend a lot more. They're not going to borrow to compensate. They're not going to borrow more in order to compensate for the additional increase in spending. Their plan is to draw down this account probably to the tune of about $1.2 trillion, get it back down to that $400 billion or so mark. Now, why is this actually a concern? Well, number one, because this is money that is currently outside of the banking system that's going into the banking system now. Number two, there is not an equal amount of Treasury bills that are being renewed as this money gets spent into the economy. That means that all of the investors, whether they're foreign central banks or institutions here in America, that currently have their money in T-bills, those bills, they're not being renewed because that money is getting spent now. And so the government doesn't have to borrow new debt in order to spend this next $1.2 trillion. And it's about $950 billion, I believe, of T-bills that they're not renewing right now. Now, why is this a problem? Just because we're going to have a massive inflow of dollars into the banking system, what is wrong with that mechanically? Well, quite frankly, the banks actually can't support it. Banks have a requirement on how much equity they need relative to the size of their balance sheet. And with a massive influx of cash into the banking system like this, it means that most banks won't be able to absorb all of those deposits. Now, right now at this moment, recording this March 2nd, there is no requirement on how much equity the banks need in order to in relation to their balance sheet. There was a suspension of that ratio to deal with COVID, but that suspension is due to expire at the end of March 31st, which means that normal banks will be held again to the rule that they have to have a 3% equity to balance sheet ratio. And if that bank is classified as a GSIB, which is a globally systemically important bank, then it's an extra 2% on top of that. So a 5% base equity to leverage exposure ratio. So what are the implications of this? If we have a ton of cash about to flood into a system with a banking system that can't support this, what is going to happen as a result? Well, number one, if the Federal Reserve is suspending their savings and money market fund reporting for the M2 supply, it's because of this, it's likely that they're already aware that this could be a problem, which means that there might be a couple of days, maybe a couple of weeks of rough waters ahead where things like money market funds are closed for redemption temporarily in order to smooth things out while the Federal Reserve adjusts the amount of assets they're buying and liquidity that they're providing through different channels. So it's possible something like that happens. A very short-term bank holiday, very short-term money market closure, suspension of redemption in order to smooth out the kinks in the system. But it doesn't, as long as they're aware of this, and that's why they're changing their reporting to make people, not really know what's going on behind the scenes, then it's likely that money printing through the right channels will solve the ripples and the tidal waves that are going on behind the scenes. It's not very likely that this actually breaks the financial system. However, if they're not aware of this, and this is just a coincidence that these two things are happening right at the same time where they're suspending the reporting and this money, all this cash is about to hit the banking system, then it's possible that the repercussions are a little bit more severe, and at least for small banks, we have some bank failures. At the very least, though, here are a few things that are likely to come about from this. Number one, negative interest rates being imposed on people so that the Federal Reserve doesn't actually have to impose negative interest rates themselves. And here's what I mean by that. Fees. Free banking is probably going away. Especially if small banks can't support the influx of all this new cash into the system because they don't have the base equity relative to the size of their balance sheet to support it, then they're going to have to be turning money away. And the easiest way for them to turn money away is to charge fees on accounts that large enough fees to discourage deposits from happening. What this will do then, if system-wide, if enough money is being forced out of checking and savings accounts, that's going to funnel money into money market accounts. The problem is money markets are experiencing the same issues that this cash is going to experience, which is namely that they are primarily invested in T-bills, which are not being renewed. Well, almost 1 trillion of them are not being renewed. And just in case you're still wondering how these two pieces correlate together, all this new money that's going to be coming into the system, all the new cash, dollars coming into the banking system, all of that is going to be flooding into mainly savings and money market deposit accounts, which are the two areas that M2 is no longer reporting on. So here's what it looks like, in my opinion, from most likely to least likely. It looks like the Federal Reserve is aware that there's a lot of money that's going to be coming into the banking system, which will primarily drive up savings and money market deposit accounts, which will make M2 explode under prior reporting parameters. In order to get ahead of this, to not freak people out so that people are not aware how much broad money supply is increasing by as a result of this year's fiscal policy, they're removing that from reporting. But I highly doubt that they're aware of the implications on the credit markets and the banking system that this will cause. Otherwise, they would be giving some sort of indication that they're open to making changes with their asset purchases, and they've done none of that. Which means that likely what I expect to happen throughout the course of March and into April is that we have, number one, turbulence in the credit markets. Weird things happening like we started to see happen in September of 2019. COVID was a great excuse for them to start to print a ton of money to deal with the problems that were cropping up months before that ever hit. The repo market exploded, if you remember, and there were problems in the credit markets coming up. So I expect to see more of that through March and into April. It's somewhat likely, though not very likely in my opinion, that we also see suspension of redemptions in savings deposit accounts and money market funds while the kinks in the system are being worked out. I don't expect to see broad-based financial system failure, banks collapsing everywhere. These types of things are able to be handled by simply printing money. It's simply a matter of opening up the right channels to get those newly created reserves exactly where they need to be, which means that I think it's unlikely, but we might have a period of a couple of days or a couple of weeks where if your money is in an account, it cannot be accessed. Further than that, it's possible again that we also see something like negative interest rates imposed, especially on small accounts through the use of fees. So if you have a small checking account or savings account somewhere, they're just going to start imposing fees so high that it drives you out. And we'll see how this unfolds. It's possible that nothing comes of this whatsoever. To me, it's a little bit suspicious that these things are happening right around the same time. And if you are fed up with keeping dollars that are losing their purchasing power, you see the costs of everything, whether it's rent, whether it's stocks, whether it's food, whether it's gas, going up everywhere, and your dollars are losing purchasing power, and you want to get your money out of the system. You want to buy gold, you want to buy silver, you want to buy Bitcoin, you want to do it in your IRA to protect yourself against the taxable consequences of the gains that are happening in those asset classes or will be happening in those asset classes. I've got all of my recommended sources linked in the description below, whether you want to purchase and store it at home, store it in a private vault, whether you want to stack sats, and you want to buy these assets in your IRA. You check out my links in the description below, and most of them come with some sort of sign-up bonus as well. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.